Day 32. Just continuing with the Indian perspective. Last part of the fourth chapter, mutual funds and other investment companies. So here we briefly discuss about the mutual fund industry in India, its regulations, tax structure affecting returns and mutual fund investments. Mutual funds in India. In the United States, the term mutual funds refers to open-end funds only. However, in India, both the open-end and closed-end funds and interval funds that combine features of both open and closed-end schemes are called mutual funds. Assets under management in the mutual fund industry were approximately rupees 2403. Oh no, sorry. Rupees. What is this? 24 lakh 300,000 301,034 crores at the end of November 2018 in India. Asset management companies, AMCs, manage a family of mutual funds. They organize an entire collection of funds and then collect a management fee for operating them. Some of the well-known asset management companies are HDFC, AMC, UTI, AMC, um, Alliance Capital AMC, um, DSP, Merrill Lynch Fund Managers, SBI Fund Management. Each offers an array of open-end mutual funds with different investment policies. By the end of December 2017, there were 44 asset management companies managing more than 1,000 schemes in India. Mutual funds in India come under the Mutual Funds Regulation 1996, formulated by the SEBI. In India, mutual funds primarily use individual agents, distribution companies, and direct marketing to sell the schemes to the investors. According to the Association of Mutual Funds of India, AMFI, there are more than 1 lakh agents selling mutual funds in India. Almost 80 to 85% of those agents sell schemes for UTI. As per AMFI, there are 10 major distribution companies and a few hundred smaller ones. Usually, the agents sell schemes for multiple funds and act as financial advisors also to the investors. Since the investors expect some financial advice from the individual agents, mutual funds are increasingly expecting the agents to have some minimum experience. SEBI has made mandatory for people engaged in marketing and selling of mutual funds to pass AMFI certification test. Taxation of mutual fund income. Section 115R of the Income Tax Act in India says that all the mutual funds in India, including UTI, have to pay a tax varying between 25% 30% on all distribution of dividends to the unit holders for money market mutual funds. The dividend distribution tax rate is 10% plus appropriate surcharges and cess for equity oriented mutual funds. Therefore, in India, taxes on dividend are deducted at source and the investor does not have to pay any additional tax. This practice is quite different from the practice followed in the United States, where the mutual funds are granted pass-through status and hence it is the investor who pays the tax on the distribution of dividends. As far as the capital gains tax is concerned, Income Tax Act of India makes a distinction between short-term and long-term capital gains. Between equity and non-equity schemes. Units of UTI and other equity-oriented and balanced mutual funds are considered to be short-term capital assets if they are held for 12 months or less. They are considered long-term capital assets if they are held for more than 12 months. Short-term capital assets give rise to short-term capital gains or losses, and long-term capital assets give rise for long-term capital gains or losses. The long-term capital gains tax rate for equity schemes is 10% for all investors as imposed on any long-term capital gains in excess of rupees 1 lakh. However, the investor has to pay 0.001% securities transaction tax STT and the short-term capital gains tax rate is 15% and is imposed on any capital gains arising out of the sale of funds within 12 months of the purchase. For debt funds, Hmm. What the hell? What? For debt funds, the long-term capital gains tax rate is 20% with indexation benefits and is imposed on any sale of mutual funds after 3 years. If an investor sells um, any debt fund within 36 months, then the capital gains will get added to her total taxable income, and she has to pay tax at the tax slab applicable to her. Thus, for example, an individual falls under the 30% tax slab, the short-term capital gains will be subject to 30% tax rate. Exchange traded funds. Benchmark Mutual Fund launched the first exchange traded fund ETF in India on January 8, 2002, with the launch of Nifty BES based on Nifty. Prudential Prudential ICICI Asset Management Company introduced the first ETF on Sensex in India in 2003 called SPICE. It tracks Sensex. The minimum lot size is 1 unit of SPICE, and the price of 1 unit SPICE is 1 by 100th of Sensex. For example, if the current level of Sensex is 40,000, then uh, each unit of SPICE should trade at 400 rupees. Since the market lot is 1, a retail investor can participate in the market by investing as low as rupees 400. There were 66 ETF trading in India. Boring stuff. Yeah. Okay, done. So let's just go over the summary once again. Um, Unit investment trusts, closed and management companies, and open and management companies are all classified and regulated as investment companies. Unit investment trusts are essentially unmanaged in the sense that the portfolio uh, once established is fixed. Uh, management managed investment companies Managed investment companies, in contrast, may change the composition of the portfolio as deemed fit by the portfolio manager. Closed-end funds are traded like any other securities. They not redeem shares for the investors. Open-end funds will redeem shares for the net asset value at the request of the investor. Net asset value equals the market value of shares held by a fund minus the liabilities divided by shares outstanding. Mutual funds free the individual from many of the administrative burdens of owning the individual securities and offer professional management of the portfolio. They also offer advantages that are available only to large scale investors, such as discounted trading costs. On the other hand, funds are assessed management fees and incur other expenses that reduce the investor's rate of return. Funds also eliminate some of the individual's control over the timing of capital gains realizations. Mutual funds are often categorized by investment policy. Major policy groups include the money market funds, equity funds, which are further grouped according to emphasis on income versus growth on specialization by sector, bond funds, international funds, balance funds, asset allocation funds, and index funds. Cost of investing in mutual funds include front-end loads, which are sales charges, back-end loads, which are redemption fees, or more formally contingent deferred sales charges. Fund and 12b1 charges, which are recurring fees used to pay for the expenses of marketing the fund to the public. Income earned on mutual fund portfolios is not taxed at the level of the fund. Instead, as long as the fund meets certain requirements for pass-through status, the income is treated as being earned by the investors in the fund. The average rate of return of the average equity mutual fund in the last 4 decades has been below that of a passive index fund holding a portfolio to replicate a broad-based index like the S&P 500 or the Wilshire 5000. Some of the reasons for disappointing record of the costs are the costs incurred by actively managed funds, such as expense of conducting the research, uh, to guide stockpiling activities and trading costs due to higher portfolio turnover. The record on the consistency of fund performance is mixed. In some sample periods, the better performing funds continue to perform well in the following periods. In other sample periods, they do not. So that's the fourth chapter, mutual funds and other investment companies. Thanks.